Hi, this is Joe Rabil. We're going to talk today about managing your positions through the use of trailing stops. We've talked about initial stops in the past, and I've shown you some of the ways that I do that. I'm going to give you a few different methods. I have studied exits, trailing stops, or ways to exit a position probably more than anyone you're going to watch on YouTube. Uh, Probably spent years going through really trying to find the absolute best method. And what I figured out when it was all said and done, that there is no best method. It really has more to do with your own personality and what suits your needs, depending on what type of risk tolerance you're willing to take. And you can adjust any one of these types of stops or trailing stop methods to suit your needs as well. But let's start going through and looking at some of the different ways that you can manage your risk. So the first way of doing it is just looking at the price structure and using the swing bottoms. And I'm only going to talk about longs today. This obviously can be used in reverse if you're short a position. Although I will say that again, when you're shorting stocks, the movement tends to be more flagrant against you. Based on short covering and such. So I think you want to be more aggressive on the short side. But let's just talk about the long side today. And one of the things I'd like to find out from you guys, what types of methods do you guys use? Because once I get through this, I want to see if any of you are using any of these types of methods as your stop and what you have found to be the most useful. And then I'd also like to find out if you're using these types of things for intraday trading or for swing trading or for longer term positions, because I'd like to get a better idea of what types of content would be the most appropriate. So that would be very, very helpful if you could just post real quick. I'm intraday trading and I'm using this type of stop. So if you get an opportunity, please post that up. So if we look at the swing bottoms, I'm going to go ahead and pull up a chart. And in fact, I'm just going to use the S&P today. It's just as easy as anything else, but we're going to assume that you're in a position in an individual stock. And let's say when the market bottomed, and I had talked about this steep trend line that was in place that had been tested several times. And let's just say, we watched this 1, 2, 3 change in trend take place, and you got long here. So if you're using a price structure or swing bottoms, you'd obviously, once that low is in place and you got long through up this level right here, your stop would go below the last swing low. And then what you would do is, if you make a legitimate low, a legitimate reversal point and then back up and test it, then you would come underneath here. And when I say a legitimate point, I don't like to use single bar down and up. So if you notice, like this bar was just a single bar down. It made one lower high, one lower low, and then went right back up. And then if you look at this, this was just one lower high, one lower low, and then it started back up again. I ignore those single bar down. But if you look at this, this was one bar that was a lower low, lower high, and then a second bar. Once I see that, and then you go back up and test this area, I prefer to get it pretty close to the prior high, then I'll come underneath this swing low. If you try and be too aggressive and just wait for one day up off this low and put your stop here, you're going to see, just to point out, you're going to see more of this happen where you go and then you make a slightly lower low and then you go and then you watch the stock go up without you. So a lot of times you'll get these little 1, 2, 3 swings. And I'm trying to get you to avoid that and try and, as long as it stays with the trend, you want to stick with it. So I want to see this test a little bit more. It doesn't have to go to a new high, but come really pretty close. And then I'll come underneath this low. So if you look at this one here, I would have definitely, using this specific method, I would have definitely come in here and I would have been stopped out on this move there. And then once the stock moved up again, and let's say I decided I wanted to enter back to the upside, my stop would go below this low. And if you use this method, you would still be in this trade because the stop would have gone here. You didn't get a good enough test of the high. You didn't make it all the way up. You did more of one of these ABCs that was more like a sideways consolidation. So you'd still be in. You had one here that was too that was, to me, 2 lower lows. That was good enough. So once this went up and tested this high, I would come up to this level. So my stop would be here, and the market just keeps moving higher and higher, and it's not making a legitimate low. Now, you could have used this, but this was a higher high and a higher low. I don't know that you could really have used this based on the parameters that I'm talking about. So what I do in this instance is if the stock or a market keeps moving up and it doesn't create one of these, then I'm going to go and do and I'm only doing that with this specific method. I'm going to do the Fibonacci levels, and I use the main range. And so what I'll do is I always want to stay below the 50%. What I typically do when I'm using this method is I go 1 penny below the 618 retracement. So I would be, I don't actually have this exact, but I would have been down at 33.46 basically, giving it a little bit of room underneath the 618, because we can actually retrace to 618 in a move like this and still be in an uptrend. Most of the time when you're in a strong uptrend, you'll only retrace 38% or 50%, but there have been times where, especially intraday, you can get down to the 618. So that's actually a pretty good method to use in conjunction with this price structure. And it's the only adjustment that I make when I'm looking at these swing bottoms, because sometimes it'll just run away and then your stop is way down here and the stock is way up here. It just doesn't make any sense. So that's really the approach that I would use if I'm looking at the price structure of the swing bottoms. If we go to the second method, which I believe is probably the most consistent, I think it provides one of the better approaches to trailing a stop, and that is using the ATR Volatility stop. And so what this does is it takes into account, so let's go back to where we were. Let's say you entered here. Now, in this specific approach, you're getting long here. You could use that swing bottom. And actually, I'll do combinations. I'll talk about that at the end. But you could use the swing bottom and then use as a trail. So that's your initial stop would be the swing bottom. And that's a hard stop. So a hard stop would be where you actually put it in on the system, where you go to your software, whether it's, for me, it's Interactive Brokers, or if you're using Thinkorswim, you'll go onto the system and you will actually put the stop loss in place. Now, I know there's a lot of you out there that say, I really don't want to put it out there because I know they're just going to take me out. And what you need to understand is that you've put it in with these systems, it's only on the software. It's not actually on the exchange. The exchanges cannot see your stops. They're only it's what's taking place is the software sees it, so that if the price is hit, then the trigger is sent to the exchange and it goes off. So you don't need to worry about, someone's going to pick me off if I put a stop loss in there. If you use stops that I think are wide enough, if you're using really, really tight stops, then yeah, you're going to get picked off. But if you use stops that have more to do with price structure or based on this specific method, which again, we're talking about the ATR, and I use a factor of 2 for the ATR. So if the average true range of a stock is $2, then I'm going to use a $4 factor, meaning it's going to be like $4 away from the last price high. And so, and I use an ATR going back 20 days. So that's kind of how I would use this. And what's going on is it's going to keep you outside of the noise. And you can use a different factor if you want. Some people like to use a 1.5, and some people like to use 3. It really is up to you. I've found that 2 is a really good comfort level for me. And it gives me enough breathing room to know that I'm probably not going to get nicked out on some little volatility, drop in the market. But at the same time, it's close enough, and it'll start to really accelerate over time if the stock gets strong and the volatility starts to drop. And if you notice in this particular one, you didn't get taken out on this swing here, which if you were using the swing bottoms, you would have been stopped out, as I mentioned the last time. But this would have kept you in. And so what I'll do is I would say use the closing price, because that's what this is for. If it closes below this bottom, or I'm sorry, this line, then you want to be stopped out. Now there are ways where you can use sort of combinations, and so I might use the last major swing low before the stock went to a new high, and so my stop might go down here. I'll talk about that a little bit more in a second. Let's go to the next approach, which is pretty simple. when we look at it, we're just using moving averages. And so if we go and look at the price action here, you'd have to start out with, a shorter term moving average. So if I'm entering here, I'm below the 40. The 40 is declining above me. So it's not like I can use a 40 MA as my stop. But I could use the 18. And again, if I'm using the 18 in this instance, I'm probably going to start with it below this swing low here, since it's still kind of declining. And so it's again, using moving averages for me, it's not ideal, but there are situations when you're trading with the trend. So if you waited for the stock to get going and you're above both moving averages, then you could use the moving averages as a trailing stop method. The problem I have with it is when you use this as a stop loss, I think you have the opportunity to get nicked out more. Just little flagrant moves intraday, and they kind of just take you. And so you got to be a little careful. And if you're going to use the moving averages, give it a little bit of room underneath. Figure out some kind of a method where you can keep it down below the moving average by a certain amount. You could even use a portion of the ATR, say like 0.5 ATRs below the moving average. That is an approach you could use. And the other thing I would tell you is that the shorter the moving average that you're using. So if you use an 18 instead of a 40, you're going to get stopped out more often. But you're also not going to give back as much from a peak. So if I were using the 40, I pretty much would still be in this trend once it got going. Whereas I would have been stopped out a few times using the 18. So it's really kind of up to you. Again, it's a personal preference, and any one of these, you could use a 10 MA or an 8 MA if you want. Any one of these methods will work. You just have to understand that the tighter the stop loss or the tighter the moving average, the more often you'll get stopped out. But there is a trade-off there. Even though you're getting stopped out more, you're actually retaining more of the gain. So for shorter term trades, you might want to have a little bit more of a tighter stop approach on a trailing method. But again, when I'm using something shorter term, if I'm trading for like swing trading or whatever, I'd rather take targets than be stopped out. So just keep that in mind as well. Let's go to the fourth method, which is actually surprisingly for me, is money management levels, which I actually use and my partner and I use a lot. So the way I would look at this is saying, if I go in and my initial stop goes here, so here's my entry. So I know it's whatever, a little bit above this level. I'm going to figure out the distance from this entry down to where my stop is. That's 1R. That's risking one level of risk. Okay, so 1R. So at 1R, once I get to 1R, I might actually go to a break even, or I might cut the risk in half and go to a 0.5R. And so I'm basing it off the risk in the stop and the trailing method. So if I get to 2R, let's say that let's just say this is a $100 stock and I've risked $5. If I'm up $10 in that stock, that's 2R. And I'm going to probably raise my stop maybe to even 5R. So I'm locking in 5R in this trade. 1R in this trade, which is 5 points. And so if you look at it that way, if you get to 3R, you might lock in, say, 2R, or you could give it more room. You could say, if I get to 3R in profits, I'm going to lock in 1R. And if I get to 4R, maybe I'll lock in 2R. And so you use these approaches, and I do recommend you use them in conjunction with a technical aspect, because I know I'm not using the technicals, but what I am using, I'm using the stock's own volatility, because the stops are going to be made and measured off of the own volatility of the stock. So if a smaller price stock pulls back like this and goes up, you're going to have like a 1-point stop, and it's as a starting point. And if you have a big price stock, like a $250 stock, this pullback and go to a new high is going to be like a 10-point drop. So the initial stop is going to be based off the own stock's volatility. And so it is sort of an ATR type of approach, where you're not an ATR, but a volatility stop approach. The only difference is that it gives you the opportunity to see in advance where your target's going to be and where your stops are going to be. So don't poo-poo this. I'm telling you, I've looked at stops in different methods for years, and I've actually found this to be one of the most consistent ways to lock in gains and and actually improve the equity line and keep it more consistent. The final thing I want to talk about is combinations. So I've already alluded to this a little bit, and the combinations would be using any one of the two methods, or even more you could potentially do, where you could use the swing bottoms and the ATR together. So if I go back and we look at the, let's actually go to the ATR. So again, if I get a stop like this, a move like this, I'm going to have my hard stop here. So when you're using the ATR, once you have your initial stop, should always be a hard stop. Always use a hard stop, meaning put it in with the system and do not mess around with your initial stop. You don't want to lose your initial capital. Once you start trailing profits, now you're trailing a stock that's in your favor. You're giving back gains. And I mean, again, you have to be careful about that. You don't want to give back a lot of your gains, but at least it's equity that you've made and not your initial equity. So I would be very careful about your initial equity and use a hard stop for that. Have it in with the system. From that point on, if I make a legitimate bottom and go to a new high, I want it to go to a new high only, I will put a hard stop in at the new swing low. And then if it closes below my ATR, I'll go ahead and stop. I'll be stopped out. So in this instance, I would still be in this trade if I'm using that combination, because this went up and tested this high, but it didn't go to a new high. So I would not have raised the stop right here. But from this point on, I would have been stopped out on this bar here. And then if I'm back in, I'd still be in this trade up until this bar here where I got stopped out based on the ATR trailer. So these are a few different methods and combinations. I hope this was helpful. Please give me some feedback on the type of methods that you've been using and which ones you found to be the most profitable, or the ones that you've had the most success with. I'd be interested to hear. And I'd really like to know if you're using any one of these. And then the other thing I'd like to know is whether you're doing this on an intraday basis, you're doing it on longer term trading, like you're looking for stocks that are moving for several months, or you're looking for just a few days. So please hit the like button if you like this material, and we'll talk to you soon.